Hey guys, it's Dave. Welcome back for another video. Today I actually wanted to talk about Meta or Facebook. It's a bit of a different topic than usual, but what's been happening to the stock and the company lately is extremely unprecedented and frankly just completely shocking to me. So I really wanted to take a closer look at it because we're seeing an amount of wealth destruction and market cap loss that I've never seen before, and I think it'll be a very long time before we see again. I think the FANG stocks, as we used to think of them a few years ago, were always considered kind of solid, big cap, blue chip stocks that you could buy and hold for many years and feel confident that you would do well. And I would say that's no longer the case. Personally, I would cut Meta and Netflix both out of the FANGs, throw in Microsoft there. Before we dive into looking closely at what has happened to Meta's stock, I wanted to just remind you that it's not too late to join the investing competition down in the Discord server. You have a few days left to get in your submission for Q3 to see how your return on a percentage basis stacks up versus the rest of us. Also, just joining the Discord server is a good time and a good place to talk about stocks. Now, lately, Mark Zuckerberg and Facebook management or Meta management have been really doubling and tripling down on this metaverse idea, their augmented reality and virtual reality future. Seeing as how this is such a big part of the future of the company, let's listen to a quick chat Mark Zuckerberg had about their metaverse and gaming in VR that they're working on right now.
For our part, we're heavily investing in building a healthy VR and AR ecosystem, so the game studios can keep building and gaming creators can keep creating. Now, Deb from our studios team is joining me. Deb, do you want to take us through some of the exciting games in the pipeline for Quest?
Absolutely. Over the years, we've had the opportunity to work with incredible developers like Vertigo Games, the studio behind fan favorite Arizona Sunshine.
I love Arizona Sunshine.
That's awesome. If you enjoyed that, Mark, I think you'll be excited that we're partnering with Vertigo on 5 more great games from Deep Silver and others. We'll share more about this lineup very soon.
What the hell was that? A little bit fake and robotic there. But anyway, I just found that clip hilarious, so I decided to share it with you guys. So moving on to their recent earnings, they actually, in some ways, didn't perform that poorly. So in terms of their revenue number, they made $27.71 billion versus $27.38 billion. So that's actually a small beat in revenue, but they did have a big miss in earnings per share, 1.64 versus 1.89. The daily active users count was right in line. Monthly active users count was actually a little higher than expected, but average revenue for user or per user was down lower than expected. So a bit of a mixed bag, really, and not something that at the face of it you would expect to see a massive 20% drop after these earnings. A lot of it is also coming down to the forecast for the future. They're also forecasting future slowdowns in these ad numbers, as well as saying that they're continuing to ramp spending on their metaverse and continue to see that as something that is a big driver for future growth. A lot of investors right now really want them to cut their spending on the metaverse. They don't see it as something that is in the near future or ready to go. And especially in current environments right now with rising interest rates, tough businesses, fears of a recession on the horizon, most investors and analysts are looking for companies like Facebook or Meta to really cut costs and try to control that. And that was a big reason why a lot of analysts were upset with this $9 billion spending number for their Reality Labs, is that comes across as a little tone deaf at times, where is really not what investors were looking for. This reminds me a little bit of Ford, who actually invested heavily in a self-driving company that they put billions into, and have decided that the technology is really just not ready. So they're writing it down as a major loss and instead focusing on lower level driver assistance technology. Investors like that because they're not just throwing more money at the problem. They're trying to be more fiscally conservative, which is kind of the opposite route Facebook took. And it's a pretty stark difference between the two companies. So first of all, just to take a high level look at the company, we're going to dive into a Simply Wall Street. It's a pretty popular investing site, gives you a lot of important data to break down different stocks for you. Let's take a look at what has happened to Meta in the last year or so. First of all, if we jump into the priced history and look at a 5-year basis, you can see it's absolutely collapsed. We are lower now than we have ever been in the last 5 years, which is absolutely crazy for a tech growth company. If we even go on a max basis, we're looking at going back until probably about 2016 or early 2016 is when we were last at these prices. Obviously, something big must have happened, right, for the stock to drop so huge. So we'll talk about that a little later in the earnings, but it's been going on for basically over a year now, not just this last earnings call, which was really like the final nail in the coffin for a lot of investors. By the way, guys, we now also have an affiliate link with Simply Wall Street down in the description below. So if you're interested in signing up for a subscription on this site, I do use it myself and find it pretty useful. There is a link, and if you use that link to sign up, full disclosure, you're helping out the channel. And there is a financial incentive for me, but I still wouldn't push something that I don't think is good. So it is a pretty good site. We can see the price to earnings ratio is now under 10, which is absolutely crazy when you think of a FANG stock or a big tech stock. Usually, traditionally, I would expect them to trade at 20 plus type thing, some even higher. Amazon was recently trading as much as 100, and historically, when things are growing fast, they can go up even higher. I think Netflix used to be something crazy like 200 plus at one point. We all know, I think Tesla hit really high numbers, but 9 PE ratio is really what I would expect from a mature company that has very little planned future growth, just be like a stable business. That's kind of where I would expect a 9 PE ratio to come in. Definitely uncommon in tech, and definitely uncommon in any companies where you think they might have the potential to grow and grow into new lines of business. We can see in the valuation of Simply Wall Street, they are doing a DCF valuation of the company. They find the price to earnings versus peers is good. The price to earnings versus the rest of the industry is good. They think the price to earnings versus fair is very good, is below fair value and significantly below fair value. The only thing they're not liking here is analyst forecasts, as a lot of analysts have recently cut their forecasts and are very much down on the stock due to the recent earnings call. So now, if we look at the forward PE, that is a little bit higher, meaning their numbers are expected to actually drop over the next year to push the PE numbers higher. Now, according to Simply Wall Street, they expect Meta's fair PE to be around 17, and we're currently sitting at 9. So they're looking at about a double based on this PE ratio of where they think it should be compared to where it is now. And we can also see with fair value, they say that Meta is actually at fair value at $500 a share versus the current $100 a share. So that's over a 5x. That's really crazy to see in a company of this size, that you might see at least the fair value calculation for Simply Wall Street this far above what it's currently trading at. Not that I'm saying that I believe that is fair value, but we definitely are seeing a massive drop, and it is a company that still has earnings. They're not in any sort of danger financially. They have a lot of cash. Now, this is kind of where the big hit has come. The future growth has become much more uncertain, and we're now seeing a future growth score of only 2 out of 6. And why is this? Well, a lot of it comes down to the fact that their ad business has been taking a lot of hits lately. Things like Apple's new ad policy restricting tracking and things of that nature are really hurting their targeted ads. We also have TikTok coming in and taking a lot of that ad revenue for themselves, and just a general slowdown in the ad market right now. We're seeing it hit Google and a lot of other companies, not just Facebook. So it's kind of a perfect storm of problems right now. Now, the other interesting thing is we're seeing they're still in good financial health despite all their recent issues on spending. They have a lot more short-term assets than short-term liabilities, as well as a lot more long-term assets than long-term liabilities. So we're very good in terms of debt levels. I look at a lot of space companies, and a lot of them look like they have scary amounts of debt that I'm not sure how they're going to pay off, how they're going to keep burning cash going forward, but this is not the case. Now, of course, I do have some questions around management. I'm definitely not always on board with Mark Zuckerberg, his style, and some of his decisions. I've found some of them a bit perplexing, but you can't argue that he did create a massive company from scratch and create a lot of wealth for a lot of shareholders. So he does have a track record of innovating in that sense. It remains to be seen, to me, how he performs as a executive of a massive company, as opposed to how he really thrived in a startup tech-oriented environment. Now he's very much making business decisions as opposed to coding decisions, which is something very different. You also have to note with this company that Mark has an absolutely insane amount of power. There's really no way shareholders would be able to oust him. He has a ton of stock, and he's really kind of in control of this company for life, which could be a little concerning if you're not a fan of his. The plus side of that is that he does have a big stake in the company doing well, so he's lost a massive amount of wealth over this recent drop, probably the most anybody has in a very long time, continues to hold a lot of stock. So now to take a quick look at the earnings results for the third quarter that's really causing a lot of the massive drop lately. Right after this, Meta plunged 20%, and we're down further since then. Revenue has dropped from the same period last year. We have costs and expenses rising fairly significantly. And of course, the EPS has dropped massively, pretty much in half at this point. So definitely a tough year and a tough quarter. Some of the top level numbers don't look quite so bad, but if we dive into it a little bit further, things can start to look a bit scary. So now we're looking at the CFO Outlook commentary here. And of course, FX is a bit of a headwind, but it is for a lot of companies as well. So I'm not too concerned about the foreign exchange, 7% hit. So 2022 total expenses is looking at $85 to $87 billion. And now 2023 total expenses, they say they're expecting to spend $96 to $101 billion, which to me is just too high in this current market environment. I think this is a lot of the reason the markets are reacting the way they are. It's just a massive amount of spend in Reality Labs and their AI and building out data centers and just a lot of stuff where most of the market and investors, analysts are looking for companies to tighten their belts and really cut their spending. They're really spending more than they ever have before and accelerating that spending. So it comes across as a little bit tone deaf to me, like they haven't really read the room or read the market environment, or maybe they just don't care about the short-term hit of what analysts think because they really believe in the return these investments will give in the long term. But there is a lot of question marks, I think, around this metaverse idea and a lot of their spending. Just to give some context for you guys, the current market cap of Meta is about $250 billion right now. So they're really talking about spending just next year pretty much 40% or so of the entire market cap of the company, which is extremely high. I do have to say, though, that this stock is looking very cheap in some ways anyway. If we just look at their core advertising business, let's be honest here, this company is trading at a price to earnings of under 9, which I would have thought was completely impossible for a company like Meta, one of these big, high, mega cap tech companies, to be under 9. I just wouldn't have seen it. Now, if we look at the historical PE ratio going back 5 years, it's by far the cheapest it's ever been. It's not even close. We're at 8.86 right now, and on a historical basis, we're looking at an average of more like maybe 25 even higher. Can go out further. So what that should tell you is that a lot of people out there don't expect pretty much any growth for the company. And yeah, here's the longer term PE chart for the entire history of its existence. We're as low as we've ever been. So in some ways, this company is tempting and it looks cheap. There's a lot of question marks around their spending, around the metaverse and how that will play out. I do really wish they could kind of be the enabler of the metaverse, make the killer app that makes everyone want it without having to dive into the hardware business and make these headsets themselves. That doesn't really seem possible though, and I can understand why. Not being in control of the hardware side of things really gave them problems when it comes to, say, Apple enforcing these new privacy rules on the iPhones. And there's a lot of reasons why you'd want to be in control of the whole experience. So that's really where a lot of the spending is coming from. Would I buy it today though? I don't know. It's very tough. I think if you hold it for the long term, they get their spending under control at some point. We see a return to a better, more favorable time for advertising spend and the cost per ad. We could see this easily go way up, but it's a bit of a risky bet right here. I mean, we can see oversold. It's extremely oversold. That's not always the best indicator, but it is nice to take a look at. I don't own it at all currently. Am I buying it right now? Probably not buying it today. I want to see if we can establish some sort of a base, some sort of a support here before I really think about it. It's tough because I don't have a ton of faith in the management, but if they just return to any sort of level of modest growth without massively increasing their spend, this company should be worth way more than it is today. Definitely a really fascinating case. So fascinating case here. On the one hand, I don't really love Mark Zuckerberg as a CEO. He's done a lot of questionable things. I think a lot of the answers they gave on this earnings call were a little questionable as well. They made me kind of like raise my eyebrows a little bit. On the other hand, the core advertising business, if they can really right ship on this, could and probably should be worth a lot more than what the company is currently valued at. As I said, the price to earnings is kind of historically low here. And even if we don't see much growth on that front in the future, you've got to think that the cash flow is there to justify maybe a higher price. One of the things that makes it so difficult is that we almost have like two separate businesses inside of the company. We have the old school Facebook and Instagram, WhatsApp, that kind of thing. They're advertising. And then on the other hand, we don't know what we're getting in this metaverse black box over here. Remains to be seen. So I'd like to see a little bit more focus put on the traditional business, kind of right ship, reduce spending. And if I see a much further drop, I might have to hold my nose and buy just because it's starting to look so low. And as well, once I see it stabilize, maybe I'll consider just having a fun little play, see what happens if I bought maybe a short-term call option, see if we get a bounce back. I don't advise that with any significant core holdings. Just sometimes I like to make little fun moves here for just to see what happens. So definitely one I'll be watching closely going forward, and I'd love to hear how you feel about it. Are you a shareholder? Have you sold your stock? Have you lost faith in the company? Are you all in on the metaverse? Are you buying at this level? Do you think it looks super cheap? Let me know down in the comments below, and I'll see you guys next time.